On behalf of REALPAC, the Real Property Association of Canada, it's my pleasure to welcome you to this webinar, where we will be discussing our low carbon financing options for commercial real estate. My name is Daryl Neat, and I'm the Vice President of ESG at REALPAC. For those of you who aren't familiar with REALPAC, we are the National Leadership Association dedicated to advancing the long-term vitality of Canada's real property sector. Our 125 plus members represent some of the largest real estate companies in Canada across office, retail, industrial, apartment, hotel, seniors, residential sectors from coast to coast. I would like to begin our meeting by acknowledging that REALPAC's office in Toronto is covered by Treaty 13, signed with the Mississaugas of the Credit. It is located on the traditional territory of the Anishinaabe, Chippewa, Haudenosaunee, and Wendat peoples, and is now home to many diverse First Nations, Inuit and Métis people, as part of an intricate nationhood that reaches across Turtle Island. So we have an exciting topic today and a good turnout for the webinar on sustainable finance. And by sustainable finance, we're broadly referring to bonds and loans with an environmental or social focus. It's clear that sustainable finance has gained prominence over the last few years, fueled by commitments to net zero carbon and the UN Sustainable Development Goals, among other drivers. What's less clear is how prominent sustainable finance has become and how much momentum there really is. Some suggest sustainable finance is elevated from a fintech niche concept to a mainstream financing tool. Others suggest that while appetite is increasing rapidly, it is still not significant in the overall context and financial system. We'll talk about this. We'll also talk about some of the key issues around sustainable financing versus traditional financing. Supply and demand, pricing, loan amounts, standards, concerns around greenwashing. And we'd be remiss if we didn't talk about the topic in the context of the current economic climate, where access to capital continues to tighten up. I'm pleased to be joined this morning by 4 seasoned experts in the sustainable finance space. We have 2 private bankers, 1 public banker, and Stuart, if you can correct me if I'm wrong, but I'm going to call you a hybrid banker. And before I ask each of them to introduce themselves, first, a little bit of housekeeping. Although we're a large group today, we're running this like a regular Zoom call. I'd encourage you to keep your cameras on if you feel comfortable doing so, and please add any comments or questions in the chat. I'll do my best to pick up on some of these as we go. We're also going to be saving a bit of time at the end for an open Q&A period, so feel free to hold off until then if you'd prefer. So to kick things off, I'd like to ask each of our panelists to introduce himself and give a brief overview of your current role. Aaron, I'll start with you.
Thanks, Daryl. Hi, everybody. Great to be here today. I guess I'm the public sector banker. Name's Aaron Berg, Director of the Building Retrofits Initiative for the Canada Infrastructure Bank.
Perfect. All right, Susan, maybe next to you.
Sure. Good morning, everyone. I'm Susan Thompson from TD Security's ESG Solutions team. So we're a dedicated ESG resource that sits within the DLR, and we act as a center of expertise to provide our clients with advisory services on everything that has an ESG overlay. So market updates, M&A and ECM advisory, carbon markets advisory, ESG strategy. We also provide advice and expertise on structuring sustainable debt products and help our clients, so many of whom are in the real estate sector, bring these transactions to market. And I'm pleased to be here with you today.
Thank you, Susan. Fanny, maybe you next.
Yeah, thanks, and good morning, everyone, and pleased to be here, and thanks, Daryl and REALPAC for inviting me. So Fanny Doucette here. I'm Managing Director and Head of the Sustainable Finance Group at Scotiabank. So what we do is very similar to what Susan just explained over at TD, being the 2 quote-unquote private bankers on this call. So my team provides sustainable finance and ESG advisory to the bank's clients globally, across our footprint, across corporate, commercial, even mid-sized companies, and we're also banking the real estate space, which is one that I followed for a long time. So look forward to the discussion.
And Stuart, last but not least.
Good morning, everybody. Bit upset by the word seasoned. I think that's just another word for old, but I'll take it. I can see some familiar faces, so it's great to meet you all. Stuart Galloway, those that don't know me, I'm the EVP for Sofiac. Sofiac is the hybrid model, I guess, on here, which is aggregator for Canada Infrastructure Bank, but we also go and get private sector, and we do a full turnkey approach to the projects, bringing in affordable finance, but also we bring in all the technical aspects to it and deliver projects for you so that you never have to spend any money. Great, and looking forward to the discussion. Thanks.
Thank you, Stuart. All right, so let's start out by describing the types of tools we're talking about here, and as well as the big picture view on where we are as an industry. So Aaron, I wonder, maybe coming back to you to start, talk about the low carbon financing, sustainable finance tools that you're involved in, and maybe your view on where we're at as an industry.
Sure, happy to. And maybe first I'd just like to do a quick overview of Canada Infrastructure Bank, referred to often as CIB. So CIB is an outcome-based impact investor, deploying $35 billion to develop the next generation of infrastructure needs for Canada. That includes our critical commercial real estate infrastructure in this country. The Building Retrofits Initiative is an initiative at the bank. We now have been live in market for 2 years after going through a pretty thorough market sounding process to get feedback from the market on what the challenges, barriers were for retrofits, deep GHG retrofits, of which Michael Brooks would remember. He was part of that market sounding, and maybe some other people on this call were involved, and we thank everyone for that. So BRI, Building Retrofits Initiative, is all about modernizing and upgrading buildings across Canada. And I say the word modernizing because I think ultimately that's what we're trying to do. We're trying to basically decarbonize through modernizing. We can say we're retrofitting buildings. I actually prefer to say we're upgrading buildings. Upgrading their energy performance, upgrading the quality of the asset, et cetera. We basically do that through tailored financing solutions that first and foremost value GHG reduction as our primary return on investment, because we're an impact investor, public sector, and we're able to do that. So we like to think that we're kind of leading the way in developing certain sets of standards, embracing most namely the IREE certification standard for retrofits, that's hosted by the Canada Green Building Council. That's one of the tools in our toolkit. It's a requirement, but we think it's an important one to start standardizing retrofits and financing for retrofits. We have 3 approaches to the market. We can do direct investment loans to property owners for multiple buildings within a property owner's portfolio. We do participation in agency agreements with first ranking mortgage lenders, the first of which you all will hear about in about 2 weeks. And we're open to do more of those with regulated financial institutions. And we do privately owned special purpose vehicle finance. Good example of that is Sofiac. Stuart's on the call today, so he'll talk about what that means, how they deliver a value proposition to the market with our capital in a turnkey, no money down, transfer of risk performance model. We target 30% minimum reduction for our retrofit projects to qualify, and we incentivize deeper retrofits with our interest rate mechanism. So interest rate decreases up to 50% carbon reduction and better. I think that's all I wanted to say for this part.
All right, thanks, Aaron. Stuart, why don't we go to you next? Aaron kind of mentioned you and Sofiac. Do you want to carry on and do the same question to you? Describe a little bit about sustainable finance mechanisms you're involved in and where you see things.
Sure, you're just trying to catch me out, aren't you, Daryl? I was still scribbling. Yeah, so Sofiac, again, I think a lot of people are aware of Sofiac, and Aaron, thank you very much for teeing that up, is we are the aggregator for Canada Infrastructure Bank. We're the first and arguably the best, of course, but we're the first aggregator for the CIB. We have taken the CIB money and we've crowded that with some private sector equity, because obviously direct approach to CIB has some criteria. So we've tried to remove that criteria. And our approach is full turnkey. The idea is the client will never, ever have to put their hand in their pocket. We pay for everything from right at the beginning, which is our cost, our risk, to full implementation of the project. And then we generate a positive cash flow for the client as well. So we take a portion of shared savings. We go and get the contractors. We have incubated in Quebec. We incubated in Quebec for just over a year. last July, we launched Rest of Canada, July 4th. And since then, we've got a pipeline of nearly $300 million, actually just over $300 million of pipeline in development. So clearly we're doing something right. And the idea is that we have de-risked these retrofit type elements to make it easier for people to say yes. The usual problem is the answer comes back as too good to be true, but I'm happy to field that question. But if that means that people are actually buying into it. But the idea is that we will actually pay for the entire project and guarantee how that is done without any risk to the client. And depending on your level of sophistication resources, we fill in around the gaps, or we can do absolutely everything. So pass that back.
Thank you, Stuart. Fanny, maybe same question to you. Go to you next.
Yeah, sure, happy to. And I think I'll probably zoom out a little bit from what Aaron and Stuart talked about and talk about the sustainable finance market more broadly. And Susan and I will split this up a little bit, because when I think of sustainable finance market, and I'm talking about the labeled sustainable finance market. So when a financial instrument has a specific label attached to it, whether it's green, whether it's social, sustainable, sustainability linked, the labeled sustainable finance market is what we will go through. When I think about that, there's two broad types of instruments within the sustainable finance space. One is the use of proceeds instruments. So that's something that's labeled green, social, sustainable, where the proceeds raised from the financial instrument, whether it's a bond, loan, or otherwise, goes to certain eligible projects. And those eligible projects are defined. There's a lot of criteria available globally, whether it's the ICMA green or social bond principles, whether it's the EU taxonomy, market precedents, but they go to eligible projects. On the green side, those eligible projects are environmentally friendly. So Stuart and Aaron were focusing in on building efficiency, energy efficiency, not retrofitting, but upgrading buildings. That is an eligible use of proceeds, where a company, a real estate company, for example, can go out to market, raise money, and use the proceeds to upgrade their buildings and get a green label on top of that. The sustainability linked, and Susan's going to go into this in more detail, the sustainability linked product is different because the use of proceeds does not have to go to eligible projects. There's just a pricing mechanism that's focused on adding some sort of ESG criteria to it. Broadly, the sustainable finance market in Canada has been about 50 billion of issuance annually. So it is quite a large market. The use of proceeds part of that, so green, social, sustainable, whether it's bonds or loans or other financial instruments, makes up a large portion of that market, about 80% of it. So the green bonds are the ones that people most commonly know. It's been around for the longest period of time. Green bonds are bonds that are issued where the proceeds have to go to green proceeds. For real estate companies, and real estate has actually been quite active in Canada in terms of issuing things like green bonds and or green loans. A large majority of the bond issuers in Canada have actually issued green bonds. But for real estate companies, a lot of the proceeds that they raise through green or sustainable bonds goes to green buildings. So exactly what we're talking about here today and what Stuart and Aaron focused on, it's either constructing or buying buildings that have some sort of green building certification. Eligible green building certifications are usually the top 2 building certifications, regardless of what certification is used. So for example, LEED Gold or LEED Platinum typically qualify as green. Anything below that typically doesn't, although there are certainly exceptions to that. So green building funding is the most common use of proceeds for real estate companies when they go to market with a use of proceeds financial instruments. But there's other use of proceeds. There's energy efficiency, which we've already talked about a lot. And one that I think has been more and more focused lately is climate adaptation. So we know that climate change is already happening. We're seeing that every year. We're seeing that probably every month. And that has a potential huge impact on our building infrastructure in Canada and in other countries. How are we preventing damage? How are we preparing our building stock for climate change? That's also an important part of the picture. We have to reduce climate change, potential climate change, but we also have to prepare for the impact because it is happening day in and day out. So that's the use of proceeds market, and I'll turn it over to Susan, who will focus on linked products.
Yeah, thanks, Fanny. I just want to add one thing on what you said, if I may. I think it actually, some of those categories that you mentioned dovetailed quite nicely with Aaron's specifications with that 30% energy reduction. What we see a lot in our energy efficiency categories is that 30% reduction. So it's a nice pairing of the two, like the private and the public markets on that. So anyway, as Fanny mentioned, one of the other financing options available are the sustainability-linked debt products. So either a bond side or the loan side. They're a new-ish instrument, I think I'd say probably within the last 2 years. And what they do is they link pricing to performance. So they differ from the use of proceeds products in two main ways. These ones are for the sustainability-linked products. Proceeds are for general corporate purposes. So proceeds of the loan or the bond, they can be used for general corporate purposes. They're not tied to specific projects or specific categories as mentioned on, so the green bonds or the green loans. The second area where they differ is companies are measured against specific predetermined sustainability performance targets. So greenhouse gas emissions reduction targets, energy efficiency improvement targets, that sort of thing. We also see social targets. So we're starting to see some complementary categories such as minority representation at the senior executive levels. The key feature here is that there's generally a pricing adjustment depending on whether or not the borrower hits or misses their targets. So without getting too much into the weeds, when structuring these products for guidance, we look at the ICMA, which is International Capital Markets Association, Sustainability Linked Bond Principles. That's on the bond side. And on the loan side, we look at the LSTA, so Loan Syndications and Trading Association, Sustainability Linked Loan Principles. I hope you're jotting down all these acronyms. You'll hear them pop up more and more. As like I say, ESG is full of alphabet soup. So I try to spell them out where we can. So as I say, these are voluntary guidelines, but they're considered market standard and best practice. Both of these state that KPIs are the key performance indicators. So what you're going to measure are material to your business. So what has the most impact? They also state that your SPTs, your sustainability performance targets, need to be ambitious, so above a business as usual trajectory. So quick example, a KPI could be greenhouse gas emissions reductions, and your SPTs, your target could be a 30% reduction by 2030, or an annual reduction of 6% per year over the next 5 years. Obviously happy to discuss in more detail. And as Fanny's saying, just to bring it back to the real estate sector, it is a very active sector. As Fanny is saying, green bonds are the dominant bond instrument. And I would imagine most of the categories in there, the most prominent category in there is green buildings. Sustainability-linked loans did see a sharp uptick in 2021, sort of held steady in 2022. But that being said, in Canada, we actually saw a year-over-year gain in sustainability-linked loans in the REIT sector. We've seen less traction on the bond side, so on the sustainability-linked bond front, versus other industries. I think it's just because buildings and the real estate sector are so, I guess they fit in better with the use of proceeds, just given the categories of energy efficiency and green buildings. That being said, I think there's a lot of room for both products to run, and looking forward to see what the future holds in terms of decarbonization in the sector.
Thank you, everyone. No, thank you, everyone. That's great. And Susan, maybe just come back on that point again, just so clear, not people didn't miss it. So the Canadian market in real estate, did I hear you? The green bonds are most dominant, more broadly, but are you suggesting that that's consistent within the real estate sector? Could you just make that last point again? Reiterate your last point.
Yeah, absolutely. I think so. What we're seeing in real estate is green bonds are by far the most prominent sustainable products in the real estate sector. But we did see on the loan side a year-over-year improvement. As we all know, last year's market was horrible across all categories. Bond volumes and loan volumes were just down across the board. But we saw that in Canada, in the real estate sector, on the loan side, we did see an uptick.
Got it.
So still below overall volumes that we're seeing in the bond side, but it did outperform its, I guess, sectorial peers in the loan market.
Got it. And then maybe just an open question for everyone before we move on to the next question. More broadly speaking, is real estate ahead of the game, behind the game, in the middle? Where's real estate as a sector on this relative to others?
I'll take first crack at that. I don't think particularly ahead or behind at all. It really depends on the organization. We are seeing a lot of paralysis by analysis at the moment. Everybody's trying to study, their portfolio. A lot of it's empty. What do we look at as far as change of use? How do we actually finance change of use? But I think a lot of other organizations are the same. Probably the industrial sector is moving fastest. The effect of carbon pricing is biting them hard, or they've realized that. Whereas I think in sort of real estate sector, where we have this large portfolio, we had a 2-year of real problem. A lot of people not really occupying that space now. So what do we do with this space? And then link that to carbon studies to, I've now got this ESG reporting and somebody's told me I've got to get to net zero by 2040. So bundling all of that into one big piece of soup has, I'd say, actually slowed the market down slightly. We've seen a lot of pickup since Christmas, though. Suddenly, it's almost like people have got their act together and suddenly realized this is a big problem. Just bottom line, big problem, let alone I want to save the planet and, grow some more trees. But just from our own portfolio management, my 2 cents.
Thanks, Stuart. Anyone else want to jump in on that one?
Yeah,
I support what Stuart said, basically. So Fanny, go ahead.
Yeah, I was going to say, from my perspective, and I agree with Stuart, I don't think necessarily grouping everyone together makes sense. There's some companies that are well ahead and some aren't as far. But in general, looking at the sustainable finance market, real estate was very quick to pick up on it, very quick to issue green bonds. And Susan mentioned in her remarks that it's because green buildings and improving retrofits or upgrades fits really nicely within the green bond instrument. So they've been issuing that for a long time. They've been doing sustainability linked loans. What I think is the next shoe to drop for the real estate space is the focus on scope 3 emissions, which is really challenging for real estate in general, because a majority of the emissions for buildings is the energy that's used for either heating space or heating water, and that's not always in the building owner's control. And so it's really that interplay between owner, tenant, looking at scope 3 emissions, what are even looking at the materials of the buildings, that is to come. There's other sectors that have had more focus on scope 3 sooner, but it's coming for the real estate space, and we're seeing progress. But I think that's something we really have to look forward to in the next couple of years for the sector.
Yeah, I think I'd echo what Fanny said in terms of preparedness. I think, in terms of issuance, especially on the bond side, the real estate sector was out, front of the pack, just with green building use of proceeds. I think even now we see a lot from the real estate sector. Just new buildings are being built. I think a lot of them have a LEED certification, probably gold or platinum certified, which fits nicely with the green building category. So there's your use of proceeds on the bond side right there. I think where the challenge is on the data side and getting that data. So I think, you have your sector that was way out in front of the pack in terms of use of proceeds and actually putting that money to use. Now it's how do we track it? How do we get ahead of the emissions that are coming up, like through our tenants to scope 3, through like our whole supply chain, like, embodied carbon when you're building the building. So things like that are a lot harder to determine and to measure. I think that's the next challenge.
Interesting, which ties back to the linked products that you mentioned in terms of when you're getting into measured targets and KPIs.
Yeah.
Great, thanks for that. Really, really interesting insights there. I just want to kind of build on that. Let's kind of keep extend it to, how would you characterize the broader opportunity of risk for real estate, owners, asset managers, investors? Like, for people that are new to this, or organizations that are just starting, obviously anything new is challenging. Get your head around and figure out what's the upside, what's the potential downside risk. How would you characterize that? And maybe Susan and Fanny, we'll kind of keep going with you and go reverse, and then back to you, Aaron and Stuart.
Sure, I can start here, and Fanny, I'll just feel free to chime in on this. I think we've already sort of talked about some of the challenges. Is going to be your scope 3 and how to reduce that, the interplay between tenants and owners, and how to decarbonize the entire value chain, not just your internal operations, right? How do you get your clients to decarbonize? How do you get your suppliers to decarbonize? And I think that's a real challenge. And then once that happens, like, how do you actually measure that too? And the data that needs to come into play on that, and how do you, if you're a building owner, you'll have upgrades to that building, but then your tenants are going to be the ones that are benefiting from that in terms of lower bills and so on and so forth. So really need to look at the scope 3. I think that's the challenge. I think in terms of the opportunities, there are lots of opportunities there in terms of new opportunities, when you can look at how do you leave the world, this is a marketing aspect, and you feel good about yourself. How do you leave the world in a better place? What can I do now that I haven't done before? Like, how can I start looking forward and taking some of these opportunities in terms of innovation, in terms of products, applying those to create like a better building? Anything to add on that?
Yeah, and I'll probably, because I know Stuart and Aaron will likely talk about the specifics, so kind of zoom out a little bit in terms of, there is a lot of the opportunities. There's a lot of ability to make changes within this sector. Some of it is easy, some of it is hard, but there is a lot that can be done, which I think is an opportunity in and of itself. Many stakeholders, such as investors, et cetera, are very focused for the companies, and I'll say investors and lenders as well, are very focused at the companies that they give capital to are focused on ESG. They are focused on climate change and GHG. So there's an opportunity for companies within the real estate space to take advantage of that and do as much as they can to position themselves as a leader within this space. And with that, whether it's being able to issue green bonds, being able to get sustainability linked loans, green loans, there can be opportunity to get capital that you wouldn't otherwise have. So on the bond side, there's definitely a lot of investors that have ESG focused funds. So if you're able to issue a labeled instruments, you might tap investors that you would normally not be able to in conventional financing. On the lending side, the same applies. I know at Scotiabank, we have a $350 billion climate commitment. So financing for climate related activities, we want to fill that commitment. So we are looking to partner with our clients, including the real estate space, to find opportunities. So there's more capital on the lending side as well. So I think that's sustainable finance within itself is an opportunity as well. There's definitely challenges, and I do want to touch upon, because you said this in your opening remarks, Daryl, that there's a lot of market volatility right now. And that has had an impact on the sustainable finance market. When there's a lot of volatility, issuers, companies tend to be focused on execution and not necessarily a label or a sustainable finance transaction. Same with investors. So there's some risk that this is a product that kind of can come and go a little bit with changing market conditions.
Thank you, Fanny. Thank you, Susan. Great remarks. Aaron, maybe over to you.
Sure.
The opportunity and risks, from your perspective.
I think the opportunity for real estate owners, investors, I already kind of mentioned, it's to basically modernize your assets, including conversion upgrades. So taking office to residential. I think Fanny made an important point around climate resiliency. So we have, climate change mitigation, which is reducing GHGs. And when you modernize, you need to decarbonize. So you're playing your part, joining the energy transition. And hopefully you end up with a climate resilient building, that's simply more valuable. Maybe it has a greater purpose and use than it currently does in the market because you've converted, again, from one office to residential or office to mixed. Repositioning of assets is essentially the opportunity. And I think the risk, to just be quite frank, is that you get left behind because the energy transition is on, climate action is on, and I think there is a supply and demand risk where if you wait too long and don't act, then you could end up behind the wave and have a hard time catching up because the supply side will be busy, modernizing buildings for the early actors, and there could be exacerbated supply chain issues like we saw in COVID. So I think early action is the opportunity, improving the valuations of your assets through modernization. Over to Stuart.
Thanks, Aaron. And Stuart, you want to keep it going?
Sure, thanks. So the role of SOFIAC, backed by Canada Infrastructure Bank and their low interest debt that they provided to us, is to actually make the projects de-risked so that they can actually go forward. So some of the challenges that we've identified and then sort of came up with the solutions for, as it were, things like triple net lease. So Susan mentioned that, who's actually paying the bill versus who's actually trying to change the assets and who's going to benefit from that, both from a carbon side, and there's obviously arguments of the reporting side and protecting your own asset versus maybe if it's a triple net, you've got the other person's actually benefiting from the saving. The other one is sale of property. Traditionally, real estate, or a lot of organizations, it's not just limited to real estate, won't invest past 5 years worth of payback. They don't want to do the big GHG, which is like 15, 20 years worth of payback, because they don't know if they're going to keep the building in there. So, we created different ways similar to CPACE to prolong that asset ownership. It doesn't necessarily have to be in the original client's ownership. The other one, which is a big one, is balance sheet. A lot of non-accountants get really embroiled in this issue. Is it on or is it off balance sheet? I can tell you, unless you're passing everything over to the private sector, it's always on your balance sheet. But that's not what really is the issue. It's, does it affect my debt service cover ratio? Does it affect my ability to maneuver as an organization, invest in new properties, divest, do whatever I need to do? So again, solutions that sit here, but sort of one of ours is, if you bring everything in a way that it doesn't affect the debt service cover ratio, that is a game changer in Canada. It's never been done before. That is making it a lot easier for the C-suite to say yes and go, actually, my business can operate as normal and I can still have that flexibility. There was a last one, upcoming code requirements. That's a big risk coming up for everybody as well. We have this exposure to carbon tax. Everybody knows what it is till 2030 anyway. So do your best to mitigate against it. We do all ESG reporting for our own lenders. So obviously that's available to a client. So ESG reporting, what does that look like for me as a client? But if I'm also looking at the requirements for code, that is now starting to be introduced for the renovation stroke retrofit market as well. It's not just about new build. So those more stringent code requirements are also a risk or something certainly to be observed to go forward. It's going to be something that's a big criteria to how we now look at these buildings, what we're bringing in terms of carbon reduction as part of that consideration when we're doing a renovation. It's not just, I just need to adapt it from that. And then the last one is change of use. Downtown Calgary, a lot of change of use there, going from commercial to housing. How do we cope with that? I know that they're fine, and we do actually have solutions, but it would take too long to go through it. But they're some of the big criteria that were identified as risk areas for people actually taking up some of these programs. And each of us on here has different ways and hopefully good ways of dealing with those.
Thank you, Stuart. So also some really good information around risks and opportunities there. I suspect a number of folks on the call would be interested to kind of lean into the topic of pricing a little bit more. So I just want to put that on the table. Fanny, I think, and Susan, you talked a little bit about supply and demand in terms of great interest on the part of lenders. And obviously there's some tailwinds for borrowers as well to be going down this road. But let's talk and lean into the pricing discussion point if we can. Anyone want to, everyone want to kind of take a crack at that? I've seen different numbers out there from different studies in terms of, rates and impacts, and let you guys, kind of answer it however you want, but it's everyone's favorite question to go straight to pricing. So why don't we try to tackle that one for the attendees?
I can start. I think, yeah, it's everyone's favorite question that no one wants to answer. And I think we were chatting about this at the start of the call. I'm going to paraphrase Aaron here and say it depends. Aaron, if you don't mind me.
Don't mind.
Feeling what you said earlier. But I think that's what comes down to in terms of, the market that Fanny and I play in terms of the bond side and the loan side. The loan side right now, it's a little more standardized than on the bond side. Typically on the loan, what we see is a 5 basis point pricing adjustment up or down. It's market standard. That's in addition to what your margin is. So that's a whole other conversation that we won't talk about on this phone call or on this webinar. But a 5 basis point adjustment up or down is fairly standard on the sustainability linked loan side. If you hit your target, then you receive a pricing adjustment that benefits you. If you miss your target, then it's a pricing penalty. But again, it's typically that 5 basis points. The bond side, it's really hit or miss these days. I think, especially given what we're seeing in the market, what we used to refer to as a greenium. So on the bond side, that would be a savings to the issuer for having that ESG. It would range from, I think in Canada, from 0 to maybe 5 or 6 basis points. But again, it's very market dependent these days. It's disappeared just given the state of the market. So we're sort of back to those where your pricing isn't felt at the onset. You may see additional interest from investors, who what Fanny was speaking to earlier. But I think on the bond side, it's a little bit harder to predict what the pricing will be. It goes back to
thank you, Susan. Thank you for tackling it. Fanny, anything to add there?
Yeah, just quickly. I think for me, pricing, I know we get asked that a lot. Everyone just said that, but it's not really what I like to focus on. And in fact, I think most companies that we've worked with that have done sustainable financing don't really do it for the potential pricing benefit, because there are other benefits to these types of transactions. And even besides, like, you look at, okay, it's a way to tell your ESG story. It's a way to amplify what you're doing in terms of you're upgrading your buildings, you have best in class buildings in terms of what you're constructing. Very, very valuable. It's highlighting how the assets that you have may have stronger valuation than your peers because you are so focused on this. But even in terms of market execution, away from pricing, we do see that transactions that have a label, so whether it's a green bond, a sustainable bond, even through volatility, will get better market execution. We saw this as recently as 1 or 2 days ago when there was 2 utility transactions in the US market. So just flipping to the US market, it is more active, both doing very similar transaction, 10-year bond, 30-year bond, both of them. One did a green bond and the other didn't. And you saw very clearly that the execution was better on the first. Investors flocked to that more quickly. Investors stayed in the order book. And in the end, they did get a bit of a pricing benefit, a couple basis points, nothing to necessarily write home about, but a bit of a pricing benefit. But in terms of market volatility, being able to say that you have better execution, being more sure of your execution, can be worth a lot more than just the potential few basis points of saving.
I think I'll go next and Stuart can wrap up, but I think I'd point out that fairly unequivocally access to capital is more important than the price of capital. And especially in current market conditions where we're seeing tightening, there's a battle against inflation, rising rates. And in terms of, what Canada Infrastructure Bank can do, there's a lot of things we can do that the private sector regulated financial institutions simply cannot do at the moment. However, we have a very important mandate to work with private capital. BRI's primary mandate is to help catalyze and transform the market for building upgrades and decarbonization retrofits. And we don't plan or intend or will be allowed to stay in the market in perpetuity. So we're here to hopefully lead on this topic of retrofits. For doing that, we can take certain risks, offer certain concessionalities to help make projects happen. We're trying to accelerate these projects in hopes that as they accelerate the volume of decarbonization retrofits, that the broader awareness of the dynamics for doing retrofits increases. And that increased awareness and knowledge essentially enables the market to function better. And then we will begin to kind of exit the market in terms of our level of participation in exchange for hopefully a fully functioning private sector market, as should be for commercial real estate. So I think with that said, Stuart, over to you.
That's actually again teeing it up for me. Thank you. There's and that role of the aggregator actually coming in. So one thing, if people are sort of going to focus on the finance side of things of pricing, is we were very fortunate in that we locked in the first tranche of the $500 million fund at rates that were pre the world, the expression, all go to shit. So we've actually locked those rates in, and we as the aggregator take the risk of our portfolio responding to over 50% GHG, such that for that element that came in from the CIB as debt, and then we married that up with green equity. Again, we secured that, we locked it in think of it as like an escrow, so we locked those terms in. So actually, there is nothing on the market at the moment that could touch the rate, but that actually doesn't really matter, because the role that we do is because we pay for everything and then hand over full 100% ownership. We actually take our return out of a portion of the third party demonstrated shared savings. So what that means is it actually doesn't really matter what the rate is, because if there are no savings, then the client pays nothing. They still keep everything, but they pay nothing. But if the savings are $100, they pay us 80, they keep 20. So the only difference about that rating price, the price of the say the debt and the equity that comes in, just means whether we can do a bigger project or a smaller project. And in this particular instance, as I say, because it's all locked in at pre 2022 prices, we can do larger projects. But even when we're already working on Sophia too, but when we get to the next stage and we still have money coming in at probably a more benchmark price, more market price, then it just means the project's slightly smaller. The model will still remain the same. And that's where sort of the CIB backing came in to help us de-risk it for our other investors, and make it more accessible, and then pass that risk avoidance over to the client. The other side of the pricing, though, is that we haven't really talked about is the commodity. So, sorry, I don't mean commodities in banking terms, is the actual assets themselves and coming in. And that is a risk, because obviously that is only going one way at the moment, especially as people around the world are trying to focus on sort of bringing in certain assets that are actually heavy in the decarbonisation. So heat pumps, for instance, everybody talks about heat pumps and the scarcity of it, and there's only 4 places in the whole world that make them. So things like that is an issue. And how do you hedge against that escalating price? How do you hedge against actually guaranteeing even getting it into your own facility now? So that is going to be an increasing issue, I think, as the world starts to take this up. So I apologize, I can't remember, I think Susan or Aaron made this point, is getting on the bandwagon now, getting it quicker, rather than being left back in the car park waving the bus goodbye. You need to actually be thinking about these things now. The decisions, this was at the retrofit conference last summer, the decisions that are made today affect whether you reach net zero in 2040 or not now, just because of the life cycle of an asset that you put in. So if you put in the wrong asset today, you will not get to net zero. You will not make the carbon savings. You will not hedge against the price increases that you're going to have in the future. So it's really important to make those decisions now. And don't wait to 2035, 2040 to get to that net zero. Do it in 2 years. Work with one of us, and we can actually get you there in 2 years and avoid all of that unnecessary expense over the future and trying to put away $2-3 million here and there, trying to get to a project in the future.
Thank you, Stuart. Some interesting comments there for sure. Appreciate the color from all. Time is our enemy. We're coming up on a little bit of our endpoint. I want to make sure we have time for the audience questions. So I'm monitoring the chat. I'm not sure I see too many for the audience, but if people want to either put up their hand or their cameras are on, now's the time to engage. I do have one last question I'd like to have all of you as you look at your crystal ball in a few years out, but why don't we hold that question till the end? And anyone want to jump in here with some questions? Just looking out across the group here.
I'll take the first question if that's okay.
Hi, sure, Gavin, I see. Yep.
So we know that there's a huge push for this, and the financing programs are very important. There's a comment on the supply side of actually being able to upgrade your buildings, retrofit your buildings, and what is your take on the supply side availability, the contractors, how they're looking at this demand going forward and the capacity today?
From a contractor perspective, I mean, I think I've heard a lot of direct feedback from construction companies that they're mobilizing for retrofits. They primarily made their money and engaged in new construction activities because that's what we've been doing. That's the party that was happening. So they're mobilizing. So I think you have, skilled labor and contractors on the supply side that need to be affected as part of the energy transition. And then you just have the kind of inputs, materials and equipment, as Stuart was kind of alluding to, around shortages of potential shortages of ductless heat pumps and things like that. I think that'll be short-lived. I think the equipment side of it will take care of itself. I think the Inflation Reduction Act in the States, there's going to be a lot more onshore manufacturing of heat pumps. In fact, with the current market conditions too, I've also heard a few instances of people canceling contracts because of interest rates and therefore releasing their orders on things like ductless heat pumps. So there is some slack, I think, emerging from the equipment side. And it is important to try to get a contractor that's committed to being part of the energy transition and is committed to kind of reinventing themselves for retrofits, not just new construction.
Okay, I see another question that's been asked on the side here. Quick one, Aaron, maybe to keep it going for you under Q&A. Any opportunities for projects less than 25 million to go through CIB directly? I believe that is your threshold.
Yeah.
Simple answer there?
No, simple answer is no. That's an internal policy threshold we have. We're managing $35 billion of Canadians' money for infrastructure. And so as an organization, we can't be spending our time doing too many transactions. I should say we only have the capacity to do so many transactions. So the $25 million threshold is pretty firm.
Got it. Okay. And I have a question on the side here I'd like to verbalize as well. It might be on some other people's minds as well as we think about it. But as we take a look at, some of the, sorry, I've kind of lost it here.
Actually, just while you're looking for it, can I just add, that's where the aggregator role comes in. So ours is $1 million threshold or several $200,000. Biggest 200 million doesn't really matter, but so that's why the aggregator role is created or was created.
Yeah, and I might mention here quickly just some stats for CIB. Like we're at $900 million of closed investments under the Building Retrofits Initiative, and that spans from a few hundred million in direct loans, almost $400 million in aggregators, and then the balance in the bank participation agreements as well, that we hope will be an emerging product for us. So there will be choice. The point is, hopefully there will be lots of choice in the market capitalized by CIB.
Daryl, could I ask a quick question?
Yeah, sorry. I just saw another one. Yeah, David, sure.
On what Aaron said, or what Stuart said, What will the impact be of the business tax credit for heat pumps? Are the commercial real estate in these buildings considered businesses as it relates to the tax benefit that's coming out in April?
The short answer is we think so. Nobody has full information yet. I think everybody's anticipating that. Excited to understand all the rules and regulations on the investment tax credit that hopefully will come out March 31st. We're already planning for it, David, as well. We're already kind of building in mechanisms in our credit agreements with our investments on how to integrate the benefits of those tax credits into the capital stack.
And I guess, as I put in the chat, the deep retrofit accelerator initiative, is that going to help? Like, is that where the action is to get people to see they don't have to pay for the study, they just have to do it?
I hope so. You know, that's Enercan's play in the market, and we informed that, saying that would be a useful kind of front end activity for them to provide funding for. So hopefully
Good question,
you guys,
David, and I think there's more to come on it. That's something I think a lot of people are interested in. I'm going to, just in light of time, I'm going to try to go to another one. I see a Q&A here from Rob Simpson. Susan Fanny, what's your view on the future requirement of having second-party opinions like Sustainalytics as a sign-off on bond frameworks? Will the market evolve so that current stop is not required?
I'll kick that off. I do actually think the opposite. And I don't know if that's unfortunate or fortunate for who asked the question. But in terms of the market overall, there's a lot more drive to providing additional transparency and to providing some guardrails against greenwashing, because greenwashing has been very topical over the last year and a half. Investors, stakeholders are worried that they can't necessarily take everything that they see as true or factual or be able to understand it. So putting additional guardrails for the market to make sure it continues to grow in a robust and credible way is really important. And second party opinions do provide, if they provide another party's opinion, they do have someone that goes and looks under the hood and provides their opinion on whether it aligns to standards, whether it's credible, et cetera. So I do think that the SPOs are actually going to grow in popularity. It's definitely a requirement for bonds. We're seeing it on some loan transactions, and you know, speaking to Scotiabank's footprint, we're very active in Latin America, quite different than Canada, different risks down there. We require SPOs for certain transactions that we feel less comfortable with on the loan side. We haven't seen that quite yet in Canada, but we are seeing it internationally. So I do think SPOs are going to grow in popularity. That being said, and I don't work at Sustainalytics, but Sustainalytics certainly doesn't have, you know, they don't check the box for they don't check the box for every transaction. They're one of multiple SPO providers. So they're not the only game in town, although they have been the most popular thus far.
Susan, anything to add there?
I agree with that. I think SPOs will become ever increasingly popular, whether it's Sustainalytics, Cicero, has to be whoever it is going to be doing the SPO. I think what we're seeing in Europe is that some of the loans are getting second party opinions on them. We're seeing the SPOs expand their services, so you know they could just provide an opinion on your KPIs and your SBTs. Just, you know, are they ambitious? Are they material? Rather than a full-blown SPO. And you know, we're seeing this in Europe. Canada's generally 2 years behind Europe, so I think there's more to come, and more reliance will be placed upon the second-party opinion providers.
Okay, so 5 minutes left. I want to wrap with a final question on you know, the current state of the market and kind of where you see things going. So let's come back to that in my opening, and I think Fanny, you alluded to it in one of your comments about the economic turbulence, but you know, we've seen the banking crisis with Silicon Valley Bank failure, Credit Suisse default. I wonder if you could speak to your immediate kind of view, your view of that effect, the impact on the immediate market of green loans and green bonds, and then maybe just looking at a few years. So maybe if we could, what's the immediate impact of that, and where do you see things going, you know, within the next 5 years Maybe go to each of you and a little bit rapid fire here to get through us. 1 minute each if we could. Stuart, you first.
Okay, sorry, trying to take it off mute. We're finding it accelerating. People are waking up to this. I mean, I'm not sort of talking rocket science here. Everybody on the call is probably just aware and tackling these issues. We're finding it exciting because obviously there's a big uptake for how to do things differently, how to actually crowd in now private sector finance and not just sit there waiting for money to come from rain out of Trudeau's pocket for our own other projects for free. We got to do other things. There's the carrot and the stick. We do have, programs like NACAN's DRAI, whatever it's called, that's coming through, but it's not enough. It's not sufficient. And with the stick side of things like carbon tax and some of the benefits and avoidance of risk, people are just finally moving forward. I do think the only thing we've got to get past is and I mentioned it right at the beginning, paralysis by analysis. By bringing in programs such as the four of us on here, is we can take care of all of that and have the delivery happening all at the same time. Don't spend, we were working with a university recently, they're paying $2 million a year in carbon tax. They've just spent $600,000 to do a study on their carbon footprint. And I said, so really that study, because it's going to take them until December, is actually $2.6 million. Oh,
okay, sure, perfect.
Really
so it's accelerating and get on with it. Perfect.
Sounds good.
Susan and Fanny, quickly to each of you.
I'll go first here. I'm optimistic. Yeah, I'm optimistic on the future. I mean, I think we may go through fits and starts given, a current market event. It may deviate focus slightly. And then we'll come back, find our footing again. I think there's still a lot of innovation in terms of both products in the market, so financial products as well as building products that needs to be done. So I'm optimistic on the future, and I think it's an exciting place to be.
Okay, we got 2 glass half full. And Fanny, where do you go?
Yeah, I think in terms of just addressing your question directly with the current banking crisis, I do think the impact is limited. We continue to see labeled issuance in the market. There's been more even today in the US market. So very limited issuance in terms of thematic labeled issuance. SVB was a big financer for the clean tech space. So I think there's a bit of a hiccup there, but the good news is there's a lot of capital chasing these types of transactions. So I think that'll sort itself out rather quickly. And long-term for sustainable financing, again, agree, optimistic. I do think we're going to see more rigor, and that'll bring more credibility to the market and allow it to grow.
Thank you, Fanny. All right, we got 3 optimists here. Aaron, are you going to pour some cold water on this? I can't
no way, man. I'm an eternal optimist. If I wasn't, I wouldn't have been doing, climate change action for the last 20 years and still be in this game because it was too hard. I think it is getting easier. We've got the wind at our back, wind in our sails. The sustainable finance movement is on. It's no longer a conceptual consideration about what we might do. It's happening. In terms of, banking crisis, and yes, there will probably be some continued, financial market turbulence. But I guess maybe as Fanny's saying, I don't read it as, and I love to read up on this stuff as it happens because I am a finance nerd. And I moved to Canada from the West Coast, so I actually know the Silicon Valley Bank guys from my days in Portland, Oregon. I think that is fairly isolated. I don't think it's a systemic global banking crisis like 2008. This is just a shakeout of irrational exuberance, particularly around crypto, tech bros and crypto bros, and they got a little ahead of themselves. And so unwinding that is probably net a healthy thing for the banking community and banking society and community in general. So count me as an optimist. I hope everyone else sees optimism and wants to embrace and join the sustainability movement.
Thank you very much, Aaron. Great to close us out. Thank you, Fanny, Stuart, Susan, and Aaron. Great discussion. I think we covered a lot of ground in an hour. We talked about some of the sustainable finance solutions out there, talked about the breakdown. I think I heard 80% use of proceeds, 20% linked products, acceleration of in both. Interesting to hear real estate industry is not at the back of the class. I think I heard we're more at the front of the class, which is good. Lots of opportunities and risks there in terms of pricing, access to capital. Interesting point, Stuart. Great point in terms of I think the risk or getting left behind. Sorry, Aaron. I think that might have been you. And an optimistic view looking forward. So appreciate it. Great comments. If anyone wants to, I think some emails have been shared in the chat, but if anyone wants any contact or follow-up, we're all available through multiple means. I'm sure you can track any of us down, but really appreciate you taking some time today, and have a great rest of your day, everyone. Thank you.
Thank you so much for the invite, Daryl.
Thanks,
Take
everyone.
care, everybody. Great to meet you.
Thanks very
Bye-bye.
much.
Thanks, everybody.
Thank other fellow panels.